morning, everyone, and welcome. I'm Helen Wilkie, a charity specialist partner in our London office, and I'm joined today by Charlotte Radcliffe, a director from our Manchester office. And today's session is all about practical guidance, supported necessarily by the necessary technical detail on the two key areas that we expect to be most affected by upcoming changes to UK GAAP, being income recognition and lease accounting. And our aim today is to give you clarity on what's changing, to help you plan effectively and avoid surprises as you implement these changes. So, moving on to our agenda for today. Here's what we'll cover. So we will start with a welcome, that's this bit, and a bit of housekeeping. We will move on to give you an overview of the upcoming changes to UK GAAP. We'll then do a deeper dive into income recognition, and I'll be taking you through that. And then Charlotte's going to guide us through lease accounting changes. We'll move on to discuss your next steps, so some practical suggestions for things you can do following this webinar, some of which you may already be working on. We'll give you a reminder of what we've covered, so a quick recap, and then we'll ensure there's a bit of space for questions at the end. Because this session is focused on sharing information, we will be in broadcast mode for the majority of it. There won't be any polls or interactive tools today because we want to ensure there's enough time for examples and your questions at the end without rushing things through. So I can see the slide has already moved on to housekeeping. So the key points are set out on the slide. The webinar is being recorded. Don't panic, you won't be seen or heard, and the recording will be available on our website within a couple of days, and we'll be sending a copy to all of you following the session with the link to the recording. A quick sort of caveat, the session is for general information only, so if you are looking for specific advice on how to apply things to your specific circumstances, as always, we'd recommend that you seek your relevant contact and reach out to them for professional advice as needed. So, moving on to give you an overview of the upcoming changes to UK GAAP. So if I start with the next slide. Thank you very much. Hopefully the two images on this screen will be familiar to you. So on the left-hand side, we have a copy of the latest version of FRS 102. And on the right-hand side, hopefully you will see Charities SORP 2026. So following extensive consultation, the Financial Reporting Council, the FRC, has published revisions to UK GAAP, and these will be effective for accounting periods beginning on or after 1 Jan 26. So most UK private limited companies will prepare their accounts under FRS 102. So that's the one on the left-hand side. If you have a trading subsidiary, they typically prepare their accounts in accordance with FRS 102 Section 1A. That's the smaller entity version of FRS 102, and it's got some exemptions. Charities preparing their accounts, if they prepare accruals accounts, and I expect that's the case for all of you on this webinar, you will be preparing your accounts in accordance with FRS 102 and in accordance with the Charity SORP, which is the Statement of Recommended Practice for Charities. So Charity SORP is all about how you apply FRS 102 to the circumstances that are relevant for charities. It cannot be inconsistent with FRS 102, and so of course once FRS 102 was updated, they had to update Charity SORP 2 to reflect the changes into there. And Charity SORP reflects those changes, and it provides specific guidance for charities on how to apply the changes to their circumstances. When do the new rules apply? The new rules, as we say on the next slide, they will start with periods starting on or after 1 Jan 26. And the two big changes are going to be income from contracts with customers and leases for lessees. So we'll get into those in more detail as we move forward. So for you, when you would need to apply these rules, I skipped a slide, it's accounting periods commencing on or after 1 Jan 2026. So if you have a December year end, these changes will first impact you for your December 2026 year end, but now is a good time to plan so as you can get that opening position right. If you have a March or June year end, these will first impact you for your 2027 year end. But watch out if you have a short accounting period. If you have a short accounting period starting after Jan 2026, that could bring the effect of these changes forward for you. So moving into the bigger changes. So the headline change, as we said, one of the key headline changes is income recognition. And there is a new 5-step model for working out when to recognise income from contracts. So these steps apply to income from contracts with customers. And so for charities, all of you joining this webinar, this will only apply to exchange transactions, not to donations or grants. So as you can see on this slide here, on this slide, we've got the 5 steps laid out for you at a very high level, and I'll guide you through these now so as you understand what each of these steps mean. For those of you who have been reading up on UK GAAP, this may be a refresher, but a good chance to consolidate your learning and check that you know what the 5 steps are. So step 1, the first step is to identify that you have a relevant contract or contracts. So a contract is any agreement that creates enforceable rights and obligations. And it can be a verbal promise, a shop sale, or a formal document. Step 2, having identified that you have a contract, you need to identify the performance obligations. So what goods or services have you promised in return for payment? It could be a single good or service, it could be a bundle of distinct goods or services, and it could be a series of distinct goods or services. And those promises, those performance obligations, they may be implied by your customary practices, by your published policies, or by specific statements which give the customer a valid expectation that you will perform something under the agreement. Step 3. So having identified that you have a contract with a customer and that you need to provide some goods or services to make good on the promises made in that contract, you need to determine the transaction price. Now, this is usually straightforward if there is an agreed price or list price. It can be more complex if you need to watch out for discounts or variable pricing. Step 4. This is where it gets a bit more complicated. You need to allocate the transaction price to each performance obligation. And how do you do this? So you allocate the price to each performance obligation based on their standalone selling prices. The exception to this is if there's only one obligation or if all obligations are satisfied at the same time. Handily, the SORP does provide guidance on allocation methods, and we will be coming to some examples as we go through. So hopefully this concept of allocating the transaction price to different performance obligations will make more sense as we look at those. The final step, the exciting bit for all of you accountants joining this webinar, the bit where you get to get your calculators out and crunch the numbers, is that you recognise the income when or as the obligations are satisfied. And this will either be over time or at a point in time. So remember that over time or at a point in time, that will become clear again as we go through the examples. And that's key to establishing when to recognise the income. And if I give you an example to kind of illustrate this, this is taken from the SORP. You could have a charity that is running an employment course where attendees pay for the course. The course is run over time. It involves attendance at 10 sessions. So the customer will receive the benefits of the course as the charity provides the sessions. In this case, the charity would allocate the fee for the course attendance as the course is delivered. So let's say the course fee is £100 in total, and the only obligation is to deliver the sessions. The charity would recognise income at £10 per session as the sessions are delivered. So that's a broad overview of the changes in the 5-step income recognition model. But as I said at the beginning, this only applies to exchange transactions. So charities are different from companies often because they often have 2 types of income. They have exchange transactions. This is what we're indicating on the left-hand side of the slide. This is where you provide goods or services in return for payment. But many charities, unlike companies, also have non-exchange transactions. So that's where a donor gives the charity income, cash or goods in kind, and the donor does not receive a direct benefit. And with respect to this 5-step model, it only applies to those income streams that would fall into the exchange transactions bucket. So as charities, you need to identify which income streams fall into the category of exchange transactions. And for many of you, you may find that this will impact trading subsidiaries more than the charity itself. So on this slide, what you can see is that we've set out examples of exchange transactions. These could be impacted by the new 5-step model. We've also set out examples of non-exchange transactions, and these won't be impacted by the new 5-step model. So exchange transactions on the left, these could be things like ticket sales, training courses where you provide training in exchange for a fee, publications where you sell educational books. And on the right, we've got the non-exchange transactions. So legacies, donations, grants, investment income. In the middle, in the blue box, you can see that we've put membership income with arrows pointing left and right. And that's because membership income can be either an exchange or a non-exchange transaction. Sometimes it's a purchase of benefits, and that would make it an exchange transaction. Sometimes, however, the substance of the arrangement is that it's a donation, and that would make it a non-exchange transaction. So if you receive membership income, you'll need to assess the substance of the arrangement and have a look at the donor benefits to determine which bucket it should go in and to determine the appropriate accounting treatment. Now, I promised some examples, so that's the theory. Let's make it practical with 3 examples. Each example builds on the previous one. So the first example that we have here is a member buys a 1-day pass to visit a historic house. In this case, what's the member receiving? Well, they can visit just once. What does the charity need to do? Well, the charity needs to keep the gardens open for 1 day. So when do they recognise the income? They recognise the income at a point in time. And in this case, it will be on the day the member visited. So that's our simplest example and hopefully quite straightforward so far. In example 2, the member liked their visit so much they've decided they'd like to get an annual pass. So they're now going to pay £120 and they can make as many or as few visits as they choose. So what does the charity need to do? Well, the charity now needs to keep the gardens open over time. So then they have to think about when they should recognise the income. And the guidance says that you can recognise the income using a method that best reflects the situation. And commonly, it's likely that in many cases, charities will consider that the best method to use in this circumstance would be to recognise the income on a straight line basis over time, in this case, £10 a month. And this final example, which is a real life example because I did a little Google to see what you might get as well as your annual member pass. In this case, the member is going to buy an annual member pass to visit the historic house, and they're going to be given a little incentive. So they'll also receive a £10 gift card for the same overall list price. So they're now paying £120 for a package deal. And the charity now has 2 performance obligations. So now the charity needs to keep the gardens open over time, and they need to give the member a £10 gift card and allow them to exchange it for purchases in due course. So to work out when the income is recognised, the first thing the charity has to do is to go back to that sort of step 4 in the 5-step model, and they need to allocate the transaction price, the £120, to the different components, the different performance obligations under the agreement. Once they've allocated the transaction price to the different components, they can then recognise the income from each component when the performance criteria is satisfied, as we discussed before. So digging into this and looking at the practicalities, we talked about allocating the transaction price on a relative standalone selling price basis. So what this means is, in this case, the annual pass sold on its own would be £120. The gift card sold on its own would be £10. So they're now getting £130 worth of benefits for the single price of £120. So to work out the value of income to be recognised for each, you allocate that £120 to the annual pass and the gift card on a pro rata basis. And that means you're allocating £110.40 to the annual pass in this case, and you're allocating £9.60 to the £10 gift card. You then consider each of those elements on their own merits. We established earlier that for the annual pass, on a normal basis, you'd be recognising it over time at £10 a month. Well, now we've got the reduced value because it's part of a package deal. So we're now allocating the £110.40 on a pro rata basis over 12 months, and that will now be mean recognising income of £9.20 per month for this package price. For the gift card, that needs to be recognised on a different basis. That gift card would be recognised, the income for that be recognised at a point in time, and that generally would be when the voucher is used or when it expires. And the allocated price for that £10 gift card, because it was purchased part of the package, is now £9.60. So for many charities, these changes might have limited impact, but you'll have to look at your circumstances to assess the impact for you. You have two options in terms of how you account for it on transition. You can either restate comparatives, where the change will result in a change to your income recognition. And the benefit of that is that you'll have directly comparable figures. So if your income was suddenly going to be recognised far more upfront, you might want to restate your comparatives on the same basis, so you're looking at like with like. Alternatively, you have got the option to record the overall impact of applying the new rules as an adjustment to opening reserves. And potentially where the impact is smaller, that might seem to be a more sensible and pragmatic option. But you have got that choice. And practically speaking, what is the impact of the changes? What do these changes mean for you? Well, potentially there could be an impact for your performance measures, for your KPIs, for your results, looking both at the charity but also at the trading subsidiaries. It could have an impact on your net assets. And for the trading subsidiary, that could mean that an impact on distributor reserves and the amount of profit that can gift aid up to the charity. And we would expect that there will be implementation time and costs. So notably, staff time spent working these things through, crunching the numbers, updating processes and documentation to ensure that you've got the right information to hand to ensure that you can calculate this and recognise income consistently year on year. So that's the first big change. And now we'll move on to the second big change. And here I'll hand over to Charlotte to guide us through leases.
Thanks, Helen. Yes, so the other big change that is coming in are the changes to lease accounting. So just to explain how the leases are actually changing, under the revisions, the distinction between operating and finance leases for lessees is removed. If we just go on to the next slide, sorry. So under the revisions, the big change is that operating leases and finance leases, the distinction has been removed. And what this means is that most leases will now be brought onto the balance sheet, which will require the recognition of a right of use asset and a corresponding lease liability. Instead of a straight line lease expense, charities will now record depreciation on the asset and interest on the liability. There are some exemptions for short-term leases and low-value assets, and special considerations apply for license arrangements, which require an assessment to determine whether they fall within the scope of Section 20 of FRS 102. With peppercorn leases, these actually fall outside of the scope of Section 20 of FRS 102, but there are still some things to consider, and we'll come back to those later on, as well as some extra things to think about for charities benefiting from social donation leases. So firstly, just to consider the impact for lessors, and that one's nice and easy. There is no impact. The accounting remains unchanged. And then in terms of how lease accounting will work under the new standards, The new model introduces a single approach for lessees. So, as I mentioned, on the balance sheet, we recognise a right of use asset and a lease liability. And in the income statement, the previous operating lease expense is replaced by the depreciation and a front-loaded interest expense. This means that most leases will now appear on the balance sheet, which will improve transparency but also impact key metrics. So, to measure the lease liability, we need to calculate the present value of future lease payments. And this is called discounting, and it reflects the time value of money. Consideration needs to be taken in respect of any fixed payments, variable payments that are linked to an index or rate, a residual value guarantees, purchase options are reasonably certain to be exercised, and termination payments if early termination is expected. So, in respect of the lease term and the discount rate, firstly, the lease term. This includes the non-cancelable period plus any extension options that are reasonably certain to be exercised and periods after optional termination dates if early termination is unlikely. The discount rate is usually the interest rate which is implicit in the lease. And if that's not available in the lease, you should use the obtainable borrowing rate. And that is the rate of interest that a lessee would have to pay to borrow over a similar term with a similar security in a similar economic environment. It's essentially the rate that could realistically be obtained in the market. So to explain this, so if a charity has a 4-year lease for a car, and a charity's unsecured borrowing rate for a 3-year loan is 6%, we would then adjust that to apply the differences between the loan. So firstly, the security, the car is secured by the car is the security for that loan, and therefore we would reduce the rate by 0.5%. And the loan is actually slightly longer than the example that we have. So we would then extend that for the extended credit risk by adding 0.5%. So in that example, our estimated obtainable borrowing rate would still be 6% because we had adjusted for the characteristics there. So in terms of calculating the right of use asset, the right of use asset is initially measured at the amount of the lease liability, adjusted for items such as lease incentives, initial direct costs, prepaid lease payments, and any estimated dismantling or restoration costs. This ensures the asset reflects the full cost of obtaining and using the leased item. So to put it into practice here, here's a simple example. A charity leases office equipment for 3 years at £5,000 per year with a 5% discount rate. The present value of payments is 13,616, which becomes both the right of use asset and the lease liability at commencement. And we then depreciate the asset over 3 years and record interest on the liability. This example illustrates the mechanics of the new model and its impact on both the balance sheet and the income statement. So if we just go on to the next slide there, please. Thank you. So you can see here that the impact to the statement of financial activities is actually greater in year 1, being £5,219, as opposed to the £5,000 payment that would have been previously recognised under the old standard. This is a really simple example to demonstrate the calculation, and it can be complicated by things such as longer term leases, break clauses, deposits, rent-free periods. But it's safe to say that judgments will be required to be made. So, how is this impacted on transition? So slightly different for leases than revenue, as there's not an option. The comparatives are not restated. Instead, the cumulative effect is recorded in opening retained earnings. And the reporters will recognise a right of use asset equal to the lease liability, adjusted for prepayments and accruals at the date of the initial application. So again, just thinking about what these changes are likely to mean for your organisation. Well, firstly, we can expect increased assets and liabilities from the leases. This could have an impact on the size criteria for your organisation. So that's whether you qualify as small, medium, or large according to the different company and charity size threshold criteria. It could also have an impact on debt or bank covenants. Lease liabilities will increase the reported debt, inflating gearing ratios and potentially breaching covenants tied to net debt or debt to equity ratios. Operating lease expenses will be replaced by depreciation and interest, and this could distort covenants based on EBITDA or interest cover. Changes in the timing of expense recognition may also affect performance measures and reserves due to that front-loaded interest. And again, give some thought to the practical implications for staff time and capacity and the need for forward planning in this area so that you build the work in ahead of that first year end. So, as I mentioned earlier, just the special considerations here. So, where the charity pays nil or only a nominal amount of consideration, these are known as peppercorn arrangements. And while these arrangements may have the legal form of a lease, it is unlikely that they will meet the definition of a lease under FRS 102, as the payments due are likely to be very small or there may be no payment due. Any nominal payments that are made will continue to be treated as an operating expense, and such arrangements are outside the scope of Section 20 of FRS 102. The charity will, however, also need to consider the benefit that is being received and how that should be measured and accounted for. If the arrangement means that an asset is available to the charity to use to carry out its charitable activities, the charity will need to identify the fair value of the asset and account for a donated asset in line with the treatment described in SORP Module 6. If the arrangement means that a facility or service is now available to the charity, the value to the charity of the facility or service is used and a donation recognised for that amount. Again, there is more detail on that in SORP Module 6. And just in respect of social donation leases, these are lease arrangements. Apologies if we just go back a couple of slides. Sorry about that. So social donation leases are lease arrangements where the payments are below market rent but are higher than a nominal amount as a result of the lessor choosing to accept a lower rent for the philanthropic intention of providing a benefit to the lessee charity. So these are a lease and need to be accounted for like other leases, but social donation leases, by definition, contain a non-exchange component. And as with nominal or peppercorn arrangements, where a charity determines that it is a party to a social donation lease, it needs to consider whether it is receiving the donation of an asset or the donation of a service or facility, and then it accounts for that donation in accordance with the SORP, recognizing the donation element as well as accounting for the lease liability. The SORP provides further guidance and examples which you may find useful if you are party to either a nominal, peppercorn, or social donation lease arrangement. And now I'll pass back to Helen for the next steps.
Thank you very much, Charlotte. So I'm going to guide you through next steps before kind of coming up with a recap. And just to highlight, if you do have questions for us, you can pop them in the Q&A. It will only be Charlotte and I that can see them, but we'll come to those at the end. We'll ensure that any questions that we read out, you are anonymous. So there is no such thing as a stupid question. So do take the chance to ask questions and get those feeding through now. So in terms of your next steps, what you should be thinking about as an organisation, thinking back to the very beginning where we talked about income and contracts, the first step we'd suggest you do is to review your income streams. Have a think about those exchange and non-exchange buckets and which income streams you have that would fall into the exchange bucket. And then consider for those income streams that do fall into the exchange bucket, those ones where you do have contracts with customers, consider whether the 5-step income recognition model is going to have any impact on the timing of when you recognise your income. If it is going to have an impact, your next step is then to quantify the impact of those changes. Then the second one, and this is likely, I think, to impact more of you, leases. So as Charlotte has explained, this is about lease accounting for lessees, where they will be coming onto the balance sheet in most cases, with the exception of the exceptions that Charlotte highlighted earlier. So identify your leases. Ensure that you've gathered the key details and you've got that information readily to hand. Do you know the lease payments? Do you know the lease term? Have you considered things like lease incentives? Make sure you've got all of that information readily to hand. Check which leases will fall within scope of Section 20 of FRS 102, and then calculate the impact. So calculate those right-of-use assets and those lease liabilities. And consider the impact, moving down to the third element on this slide, consider the impact of changes to income recognition and changes to lease accounting on your financial statements. So consider the impact that they could have on your results and also the impact they could have on your financial position. As Charlotte said, bringing right-of-use assets onto the balance sheet is likely to increase the gross asset values that you have, and that could have an impact on the size of your organisation as set out by those Companies Act definitions, and whether you are small, medium or large, and that could have knock-on implications for your wider financial reporting obligations. It could also have an impact on key ratios, and it could have an impact on covenants. So for those of you with bank loans and debt financing, have a look at those covenants and consider the implications for those areas to make sure you don't have an unexpected breach. Consider your systems and controls, your policies and procedures. So do you have the right processes in place to ensure that you have the information to hand and can account for your income and leases correctly and consistently in accordance with the new financial reporting standards? And consider the implementation time and costs. It will have an impact on capacity in your organisation, and have a think about who will need to feed into the process, both within the finance team, but also more widely. And then, as with all things, and these things are not necessarily in order, so you may start with thinking and planning and communicating, and that's likely to be a constant feedback loop as you go through. So make sure you're talking to staff, inform them about the implications of the changes for them. What does it mean for them? What do you need from them? What actions are required? And brief trustees. So it's likely we would expect the trustees are going to want to understand what processes and plans you have in place to ensure that the organisation is ready. What will the implications be for the organisation? What will the implications be for the financial statements? And what plans do you have to address it, and to talk to them as you go through the process? And how can we help? So hopefully this webinar, which for some of you may be a refresher, and for some of you may be hearing this for the first time, hopefully this webinar is part of how we can help to give you clarity and confidence as you navigate these changes. But we recognise that as you go through, as you look into the specifics, that's likely to prompt new questions, and you may need to dig into those in more detail, and you may appreciate having someone on the end of the phone that you can talk to. So do reach out, do drop us a line, do speak to your usual kind of audit team and advisors as you go through. Specifically on leases, Charlotte and I know that the team here have been working on pulling together a template that we will be able to share with clients in due course to help you to calculate your lease liabilities and right of use assets. We've seen it in advance, but we understand it's going to be available on request in the coming months. So there will be a tool available to help you crunch the numbers. So now, whilst you're still thinking through your final questions, a quick recap on what we've covered today. So what's changing? UK GAAP and Charity SORP have both gone through a refresh, and there will be changes which will apply for accounting periods commencing on or after 1 Jan 2026. The key changes are income recognition for exchange transactions, so that's contracts with customers, and lease accounting for lessees. And your next steps are to assess the implications for you, to form a plan, and to communicate.